Let's review Chapter 16. Chapter 16 is about intercorporate investments, and we'll talk about what that means and why that's important for companies. And remember, we're looking at this from the lens of being more of a financial analyst. And so we need to have the ability to look at a company's financial information and understand it and make decisions. And so keep in mind that companies own stock of other companies. It's very frequent, very common that you would do that. And you do that for a lot of different reasons. Sometimes you're just buying a few shares just to park some cash, and you believe another company's stock is a good bet, a good value. You buy it, you earn some dividends, and you plan to just sell it at some point and hopefully, do the old buy low, sell high. That would be pretty common for pretty much any corporation out there. You pick the company that has extra cash, they park it, they put it somewhere, just trying to make money on it, just like any individual would try to do. You've got those kind of investments, but then you also have investments in other companies where you do desire, you want to influence, you want to have enough shares that you can vote for somebody in the board of directors and be able to elect somebody specifically to the board and to have some control or influence. And the rules have changed quite a bit over the years on these, especially because of the Enron stuff back at the turn of the century. The rules changed a little bit over the years. And a lot of what we're going to cover in this chapter is kind of a precursor for some of the stuff that you'll cover in advanced accounting. So for those of you moving on to advanced, which is the accounting majors, you'll do this kind of stuff in that class also. It'll be maybe a couple of chapters worth of stuff that you'll do there. But for those of you just minoring in finance, it's still important to be able to look at a company's financials and make decisions. That's really what the point is from our perspective here. It's just looking at a company's notes and their balance sheet and going, what does this all mean? How do I make decisions about what the company is doing based on what I see? So that's, basically just being passive is one thing. And there's different levels of influence here that I want you to recognize. And there's some new terminology here you probably haven't seen before. So let's look at the passive column right here. Level of influence, no substantial influence. If I'm a company and I'm just buying a few shares of stock just to as an investment, no big deal. I have zero influence, right? Like I personally own 10 shares of Apple. I have no influence whatsoever. If I had a million shares, maybe I'd have some influence, right? Level of ownership, generally less than 20%. And then we also have what we call trading securities. And trading securities are fair value measurement with unrealized gains and losses reported in the income statement. Okay, so we've got trading securities. We have also what we call available for sale securities, fair value measurement with unrealized gains and losses reported on other comprehensive income. And then it says beginning in 2018, so just a couple of years ago, fair value measurement with unrealized gains and losses reported on the income statement. Okay, so that's a change. So now for both trading and available for sale, they both go to the income statement. Now, it used to be that fair value adjustments for available for sale went directly to the equity section. That's what other comprehensive income means versus directly to the income statement. Now, classifying something between trading and available for sale is very gray. It's up to the company, and I worked for a company where we did this. We had billions of dollars worth of stocks that we owned, and we classified. What we did, what we discovered was it was just easier to call everything available for sale as opposed to parking some in trading and some in available for sale. And GAAP is pretty open about the classifications. Trading means you're buying it and the purpose is you're going to immediately resell it, fairly soon, but you don't have to. I mean, it doesn't mean you have to resell it. Available for sale means you buy it and you may sell it somewhere down the road. It's very gray, the definitions between the two. And we discovered our auditors were okay with that because they believe too it was just easier for them if we just focus on everything being available for sale. It's up to the company though, so that was just my experience with it. Okay, Then we get minority active, and now it says controlling. Okay. So now we've got some level of control. And keep in mind, you can have control less than a 50% owner. It's very, very possible. Think about why that might be. Some companies have millions of shares, tens of millions of shares of stock floating around that people own, right? And if you own 20% and nobody else is even close to owning 20%, that's going to give you influence. Okay. If you've got 20% of the shares organized under one voting block and nobody else has anywhere near that, then you've got control. You have major influence on who sits on the board, management decisions, and things like that. So you can be a minority owner and still have control. Okay. And so that's very important to understand. And then it says under the equity method, you do what they call a consolidation. We'll talk about that. And then we have what we call the fair value option. And those rules changed with Enron. With Enron happened back in 2001, a lot of these things changed, and they took out some of the old stuff and put in some new rules and so on. And this is even changing again. This mentions here too that all these rules changed again. They kind of got refined um, after the 2008 Great Recession. I think over the years since then, I think there was some realization that some of this accounting needed to be firmed up. And the FASB went through a very long process to kind of go through and do some studies and analysis and figure out some better ways to do this. So they made changes effective in 18, but they were not significant. The significant changes happened back in 2001 because of the WorldCom and Enron scandals. Okay, let me get this back where we can see it. So, and this shows you through 2017, under rules in effect through 17, passive investments were classified in one or two ways. Now, after this, though, they're treated the same way. So it used to be we treated things differently. Trading securities, their valuation changes went to the income statement, and available for sale went to the equity section. Both are initially recorded at cost, and then every balance sheet date we do change them to fair value. We do that still, and that was again another rule that came about because of Enron and WorldCom. Was It was believed that we need to be more transparent on the balance sheet and show as many assets as possible that made sense at their true fair market value as opposed to their cost basis. Remember that typically your property, plant, and equipment assets are recorded at historical cost minus depreciation, so we call it book value. But a lot of companies, when they take extra cash and they buy investments, they're buying stocks and bonds, those are trading on a market. So there's no question what these stocks are worth. And even, a lot of companies may have private equity investments and so on. You can still go through a process to value those. And so that's kind of what happened when the fair value accounting occurred and when those rules happened. Initially, we had the trading and available for sale, and we accounted for them a little bit differently in terms of the valuation changes, income statement versus balance sheet. But that's all, we still do that. So even though the trading and available for sale are going to be treated all the same now, we still do a valuation change every year. So basically, every balance sheet date, you look at the cost, look at the new fair value, and you make adjustments to that. So the goal is that you report as many assets as possible at their true fair market value. Okay, now, kind of excluding property, plant, equipment, that's a little bit different. So, but we're talking basically investments where you're trying to earn a return, and a lot of companies have those. So that's very important to understand. Okay. With this in mind, is kind of shows you here an example, and I recorded some problems that will help you understand these two just a little bit. But you can definitely just take a look at these on your own if you would like to. I think it's pretty easy to follow these through on your own. But the key is that every year you have to mark these to their fair value. And this is just different securities that they own. And so they're kind of just walking you through that process to do that in the journal entries. And what I want you to kind of recognize on the journal entries is what we're doing, calling these unrealized holding, either gains or losses is what we call these, unrealized holding gains or losses. Okay, so this is the rules that you would all be living with now. This is beginning in 18. So when you start your careers in accounting or finance, this is the rules that you'll be dealing with going forward. Accounting for minority passive equity investments is changing for public companies, effective 18 for firms that report on a calendar year basis. And it says here in general, all minority passive equity investments will be accounted for at fair value, with changes at fair value going through net income. And that's the major change. We don't care anymore about that trading for available for sale. And I think that's what the FASB ultimately realized is that companies really weren't putting a lot into trading. They were putting most of it into available for sale. And the purpose and the reason the company I worked for, we did that is because that available for sale change for us, it went through the balance sheet. It just went through the equity section on the balance sheet. And so we were not impacting our income statement for changes in fair value. We just didn't like doing that. But now you have to go do it through the income statement. So that was the reason we did it. But now that distinction is no longer really important, and all these valuation changes go directly to the income statement. Okay, so that's one major change that you will see once you are in your careers going forward. And it says also we now use what they call the cumulative effective adjustment beginning at the year of adoption. So, and then calendar year firm started this December 31 of 17. And as of January 1 of 18, the balance sheet is reflected to update the balances that um, would have been had the firm always used the new guidance. So whenever they come out with these new accounting rules, you have to adopt them and they always give you guidance when you read these rules. The rule will probably only be a page or two, but there's page and page and page of adoption. And that's how they kind of walk you through the process you go through to actually run it through your financial statements as in the year of adoption. That's the most complicated year to do these. I've done a few of those, and they're really a pain to do. So the effective adjustment was a reclassification between accumulated other comprehensive income and retained earnings. So you have to kind of go back and show here's what our numbers would be had we always done it the way that it is now under the new rules. So now we're going to talk about minority active investments. And remember, we're kind of in this neighborhood right here. We don't own more than 50%. We own under 50%, but by being active, we have some kind of influence. And it says here we can use the equity method or the fair value option. Okay, so down here, and they'll tell you when the problems like, they're not going to make it be a mystery if there is influence. They'll tell you. So don't worry about that in the problems. You don't have to guess. They will just tell you. Let's take a look at the equity method, and it's possible you've not seen this method yet. I don't think we cover it in principles. I don't remember anymore. It's been a while since I've taught it. And I know we do cover it in intermediate, and we do cover it for sure in advanced. So depending on what classes you've taken, you may have seen this. I don't think anybody here in this class has taken advanced yet. I think you'll take that all next year. But the equity method, it's the good news is it's really easy. It's a very super easy method to use. And you choose this investment by investment. You don't do this for all your investments or none. It's investment by investment. So number one, it has to be a minority active investment, and then you choose the equity method. It's super easy to do. There's just a few things to keep in mind. You record the initial investment at cost, and then the investment accounts increased for your pro rata share of net income from your investee, and then it's reduced for things like dividends and so on. So it goes up for net income and it goes down for dividends. And that's basically the rules here. And so they're going to walk us through an example here. January 1 of 17, Willis Corp purchased 30% outstanding shares of Planet Burbank for $9 million. The book value and fair value were $30 million. So it pays book value for the investment, $9 million. So debit investment, credit cash for $9 million. And during 17, Burbank makes $10 million in profit and declares a $500,000 dividend. So basically, you reduce the investment for the dividend and you increase the investment for your share of net income. So we own 30%. They paid a $500,000 dividend. So we debit dividends received and then we credit investment in the investment account. And then we debit the investment account and we credit income from affiliate for the $3 million, 30% of their net income of $10 million. And so the carrying amount, then the initial carrying amount was $9 million when we bought it. We increase it for the net income. We reduce it for the dividends paid. So we get to 11,850. So that's the kind of the key to how that works. So really straightforward. I don't think you'll be too challenged with those. Now, where it gets more challenging is when cost and book value differs. And with this one, the book value and the cost were exactly the same. So that was very straightforward. Okay, but when they differ, we get goodwill. And that's actually more the norm. Kind of think about when you buy another company and you're buying enough shares that you have some influence and some control, that to get the sellers to sell to you, you have to give them a reason to sell to you. And quite often that means you have to pay them an amount above book value to do that. Okay. And you're buying the brand name, you're buying technology, patents, processes, trademarks, the people, their expertise, their locations, maybe, whatever it is. The reason that you pay more is you have to give that the owner selling to you an incentive. You have to give them a monetary incentive to make it worth their time, especially if it's a company that's owned by the founder and it's their baby and so on, right? So it's very common that you pay more than book value. That's called goodwill. Okay. And so goodwill exists because a thriving, successful company generally worth more than the sum of all of its net individual assets. And that's very common. And keep in mind, I mentioned earlier that property, plant, and equipment assets are carried at cost minus depreciation. Okay. But let's just say the company that we're buying has significant buildings and land. Buildings and land typically go up in value. And if they have very desirable locations, those go way up. So we have to think about things like that and go, well, if they've got good locations and they're building and land, they've got a lot of those go up in value. We never write up those assets on a balance sheet. We never do that. We only do that when we do a purchase like this, and then we do a fair market value. So quite often, property, plant, equipment assets, especially building and land, go up in value. Things like machinery, equipment, furniture, vehicles, they're all kind of what you call more of a wasting asset, and their value goes down once you buy them, right? So a good category goes down in value over time, but if we have a lot of building and land, those will go up in value over time. So that influences the amount of goodwill potentially also. But whenever there's goodwill, we then have to amortize. So the cost of shares acquired exceeds the underlying book value at the acquisition date. The investor is required to amortize any excess attributable to separately identifiable assets and liabilities not having an indefinite life. So amortization is recorded as a reduction to investment income and a reduction to the investment account. And this is going to be more the norm. Okay. So now we're going to take the same scenario, but now Willis is paying more than book value. So now they're paying $24 million for 30% and 15 million more than 9 million. So they're paying a $15 million extra kicker for this company to get the 30% of it. And so what you do in that situation is you have to compare book value to fair value, right? So inventories, fair value is much higher, depreciable assets much higher. Cash is cash, that doesn't change. Liabilities were the same. That's pretty common. And you can see the difference now is 40, and then the investor share at 30% is 12. So we do this fair value, and we go through the process. We make a deal like this, and what we're doing is we hire somebody to help us out, right? So accounting firms specialize in acquisitions, and so an accounting firm would go to the company that's being acquired, Planet Burbank, and they would go through the process of revaluing all of its assets. They look at all of its inventory, its depreciable assets, and go, what's the true fair value of these today? And they'll go through the process of figuring that out. So if it's building and land, they'll hire appraisers to do evaluation and so on. So it's a process that many accounting firms will do that. They'll have a group of people who specialize in this kind of stuff. And so for the acquiring company, Willis, they basically had to pay an extra $3 million now to get it. So they paid an extra $3 million to get Planet Planet Burbank to sell to them. So the difference between fair value explains. So this basically 12 million of the difference is explained here, but 3 million now that goes to goodwill, which is unexplained. And that's the goodwill is, maybe they've got good locations, they've got a large customer base, they've got technology or patents or people who are really smart and know their business. That's the kind of stuff we have to look at. So now that we've done that, we've established that, we can now record the journal entries. So same journal entries as before, but now with a twist because we overpaid by that $3 million, and we did this fair market value valuation also. So investment plan in Burbank 24, credit cash for 24. We received the dividend again. We received the income again. So we know those are the second two entries right here are the same. But now we've got to keep track of amortization. So that's is where now we have to add this new thing. We had that inventory, we had depreciable assets, and we have goodwill. And so we have to amortize those. So inventory typically gets sold within a year, right? So that was easy. We just basically say, well, that inventory valuation goes away in 1 year, because typically you sell all of your inventory in a year. The long-term assets, though, we're just saying those will last 10 years. So $9 million divided by 10 is 900,000 per year. And then goodwill, we treat differently. We don't specifically amortize goodwill. We do something a little bit different than that. So that 3.9 million, we have to make this extra entry now to debit income from affiliate and credit the investment for the amortization that we had to deal with. Okay, so fair value option for equity method investments. Okay, so now we could also elect a fair value method for these. We're allowed to do this on the election date when one of the following events occurs. The firm first acquires an investment eligible for the equity method treatment. The investment becomes subject to the equity method accounting, and the investor ceases to consolidate a subsidiary. And consolidation, that's what you do in advanced accounting. So I'm not going to get too deep into that. You will, for those of you moving on to advanced, you will deal with that then. Okay, so if we do this, unrealized gains and losses from changes in fair value reported in the investor's income statement. The investor firm does not report its proportionate share of investee profits and losses. Dividends received flow directly to earnings, and then the asset and liability measured at fair value must be reported on the balance sheet separately from investments. And then we have to talk about the controlling now. So now let's talk about controlling interest consolidation. So now we own more than 50%. Okay, so before we talked about being a minority owner, now we're a majority owner, so more than 50%. So there is no question that we control. Once we own 50% or more, we now have a controlling interest. And so it's called acquirer or parent company. So you've got a parent and subsidiary relationship. So a controlling financial interest is generally deemed to occur when one entity directly or indirectly owns more than 50% of the voting shares of another, called a subsidiary. And then we do what we call a consolidation. And as I mentioned, that's a lot of what you do in advanced accounting is you learn how to do consolidations. And keep in mind, a lot of companies this is the norm. It's not just the one company. They own other companies that you maybe never heard of, right? And they're all consolidated because they're one economic unit. So all these companies work together and they're one economic entity, so they consolidate these subsidiaries into one set of numbers. And the work papers to do this can be pretty complicated. I've done these in the past, so I have done them many times over the years. In this example, Alphonse buys for $10 million all the outstanding shares of Gaston Corporation. And it's 100% acquisition. The balance sheet of Alphonse immediately before the consolidation, this is the parent company. You can see what it is here. And then after Alphonse's current assets will be $10 million lower because they spent $10 million in cash on this, and they'll have an investment account of $10 million. Okay, so that's a little bit different afterwards. And this is the process of a consolidation right here. This is a very basic one, and I just want you to be kind of aware of how this works. So now this is after Alphonse has made the purchase, because now their cash is down 10 million lower, and now they've got this new investment account in Gaston for $10 million. And then we've got Gaston right here. And then we have to eliminate things that are common. So we have to eliminate, and we've got two elimination entries over here. Letter A is we have to eliminate the investment in Gaston account, and we have to, for entry B, reclassify the remainder of the investment account. The key is that when you get over here to the consolidated column, the investment in account is gone. It's not there anymore. And the equity of the parent is the same equity over here in the consolidation. So you have to eliminate the equity of the subsidiary. So I want you to recognize that Gaston's equity, the 6 million here and the 2 million here, those are gone. We move those over here. Entry A, we put those over here. And then, so entry A is just getting rid of the subs equity, but we still had $2 million left over in the investment account. That $2 million was moved to fixed assets and goodwill. So that extra $2 million, $1.5 million went to assets, and the other 500,000, whatever's left over, goes to goodwill. So you can have goodwill in the consolidated. That's very legitimate. We've got that. But the investment in account goes away, and the equity of the parent is the equity of the consolidated group. That's the key thing to remember, right? Okay. Those are just that's a very basic consolidation, very basic consolidation. And for those of you moving on to advanced, you'll do some more complicated ones when you take that class. Okay, and this kind of walks you through all the methods that we've had over the years. Back in the day when I was as an undergrad learning this stuff, we had the pooling of interest method. As I mentioned, the Enron WorldCom scandals in early 2000 that resulted in some significant changes, and so that method went away. And then we went with goodwill, and we used to just amortize goodwill. That was something that was the norm. We would just amortize goodwill over not more than 40 years. So 40 years was the max. That's what we used to do. Okay. So it said 2001 earlier. And then in 2002, so ever since 2002, which is today, we now, it says goodwill is not amortized. And instead, we do an annual impairment review. Okay. So that's something that's newer. So I had to relearn that method back in the day. And then the presentation of non-controlling interests. So after the 2008 kind of Great Recession, you may call it, they felt the need to redo some of the non-controlling interest rules and how those things are presented on financial statements also. So we used to call it minority interest, and they changed that to be non-controlling interest. So now it says 2009 and after. So this is what we need to focus on. Net income is before subtracting non-controlling interest. Consolidated net income separate into portion attributable to non-controlling interest and portion attributable to parent company shareholders. Okay, so just want you to kind of know that that's changed over the years. Oops, let me get so beginning in 2009, consolidated net income is defined to include all earnings of a parent and its consolidated subs, even if the consolidated subs are not wholly owned. And that was a big change. That was something significantly different than it used to be. We used to call it minority interest. Now we call it non-controlling interest. Another thing that changed significantly after Enron and WorldCom is what they call a VIE, the variable interest entities. And WorldCom and Enron both, Enron especially, were major abusers of setting up other small companies and parking bad stuff on them, like debt and things like that, and then never consolidating those into the main company financial statements. And they were following GAAP rules with some of that stuff. And so the GAAP rules changed significantly because of what they had done. And and that's where this term controlling interest came about, is instead of just looking at a percent owned, it became more, do you have influence and control? That kind of became the new rule. And as long as you have influence and control, it doesn't matter what percent of a sub that you own. If you've got significant influence and control, now you have to consolidate that VIE into your consolidated financial statements. And the rules are right down here: the power to direct the activities of a VIE, and then the obligation to absorb losses of a VIE. Okay, so those are the key things that have changed. So a little bit subjective, but the point was to try to make sure that the bad actors can't act bad anymore. And then we've got a few other topics here, accounting for foreign currency transactions. Remember that when a US company has business overseas, you have to basically um, take that foreign currency and bring it back to the US dollar when you do your financial statements. And foreign currency valuations change daily just based on economic conditions and government policies and all kinds of things. And so we have to make journal entries to do that. So they're just showing us a few entries right here to do that. And just a few more right there. So let you take a look at these ones. They're pretty straightforward. The good news with these is they're really not too hard to do. So, um, the key here at the bottom, I want you to recognize that we could incur a loss. We could have both a loss or a gain on these depending on the direction of the currency translation. Okay, and there's another one right there you can take a look at if you would like to. Um, and then sometimes, and this first one dealt with inventory. Now we're going to deal with one that's maybe more of a non-monetary asset. So now we're going to look at more of a building, and that's generally the same with a few nuances. Yeah. And then it says here accounting for investment and debt securities. Remember that the rules changed in 2018. And also they're mentioning one right here, held to maturity, which we haven't mentioned before. And this is debt securities. So the available for sale and trading dealt with owning common stock. Now we've got, what if you own debt? How do you handle that? They call that held to maturity. So debt securities are classified as held to maturity, trading, or available for sale. So with debt securities, now you've got the three classifications we added, held to maturity. That's the new one. So under the accounting for minority passive equity, part of the rule change of 18, there are two possible classifications: trading and available for sale. We now have held to maturity. And for those, and this is basically are those for which the firm has both the intent and the ability to hold until maturity date. So held to maturity means we're going to own it until it matures. That's for a debt security because common stock does not mature, but debt securities do. So what they mean here is you've got the ability, meaning you don't need to sell it because you need the cash. So you can afford to hold it. You don't have to wait, sell it now to get the cash type of a deal. Okay, and they're going to walk us through that. So this looks a lot like an amortization table for debt, and you've seen those before. We've done those in previous chapters. So it's very similar type of a process we go through with these. Um, and it just kind of walks us through the journal entries to record a few of these. And when you do the problems video, I've got some help there for you with this too. So, but this is a good example to follow, just to take a look at this one for this chapter. But then also keep in mind that for debt, we can also do the available for sale or trading thing also. So we can do those. Okay. And then the very last topic, they call this other than temporary investments, or OTTI is the term that I used in industry when we have these types of things. So other than temporary means permanent. Okay. But why they couldn't use the term permanent, I don't know. Maybe that would have made too much sense. But basically what you do, we had to go through this test every year because we owned a lot of bonds at the company I was at. We owned billions of dollars worth of bonds. And if bonds lost their value, we'd have to go through the process of saying, as they lost their value, was that temporary or was it more permanent? And so if we, and we kind of went with a timing. Basically, if they had gone down by a certain amount over a certain amount of years, we usually kind of went with a 2 year rule. We would say it's other than temporary. So if their value had declined by a certain percent for more than 2 years, we basically said that the odds of them coming back up are pretty slim. And what that means is the company that issued those bonds, they're having financial issues, and so the bond price comes down because of that, and the bond value comes down. So possibly they missed an interest payment, or there's a thought that they may declare bankruptcy. There's some underlying issue with the company that we believe is going to affect the ability to receive the full amount owed to us on the bonds. That's really the issue with OTTI. And so it's a little bit of a judgment call. We always had to go and run this through with the auditors. In fact, typically we just had our list in front of us and we just sat down with the auditors and we just kind of together kind of agreed by security. So it took a few hours to go through and do this, what was impaired and what wasn't. And so what we discovered was if we just worked with them right away to come up with this, it was a lot easier than trying to explain it afterwards if they were involved in the process because they have to sign off on this kind of a calculation. So it was kind of a big deal. So just, they'll have a few questions in your homework about OTTI. If you have any issues with the chapter, just let me know. I'm more than happy to help.